Sherry, we came into today with more optimism from that PPI report as the leading indicator to what could be another lower CPI print on the horizon. What did you make of it?
Yeah, I think that's exactly right. I mean, what we're learning, once again, I don't know how many times we have to learn this lesson, is that the economic data occurs in arrears. These Fed hikes are starting to take grip. And we also learned today that the U.S. consumer typically doesn't stop spending. They just shift their spending, which is where we're going to see the winners and losers within the sectors, some of the earnings of which we saw today.
Yeah, I am curious about that. I mean, there is a sense here that consumer spending, at least based on what we know right now with regards to household balance sheets, certainly has plenty of capacity, I guess, to keep spending. It's just a matter of where that money goes.
Yeah, it's crucial. You know, 70% of GDP is consumptive based in the United States, and the consumer, despite all of the economic and political and now global political turmoil, the U.S. consumers really stayed focused on their pocketbook, their balance sheets, and U.S. companies are doing exactly what they should be doing, regardless, which is tightening their ships and controlling spending.
Talk about the political and the geopolitics, at least of today, and I guess you can say really for the year when it comes to war in Ukraine. Are clients really paying attention to that from a financial management perspective?
Yeah, they're absolutely paying attention to it, particularly like my clients that sit in the baby boomer and above set. It's a real cause for worry, and I just really remind them in a very disciplined way that geopolitical and policy issues are market disruptors. They're not dislocators necessarily, which is why we see the markets turning positive today. There's always a pocket of opportunity that a market presents to us in any given moment of change. And right now, that pocket of opportunity is very consistent around dividends, income, stabilizing cash flows, and segregating out good earners and good leadership within corporations.
Where's the pocket of opportunity in fixed income markets, which again are showing us a little bit of a flight to quality and thinking about how we're pricing in peak inflation? Yeah,
I would say we want to have pockets of tolerance. The bond market, I don't know if I'd characterize it as an opportunity set, but clearly
4%.
I know clearly the front end of the curve is where investors should be right now, largely because we've seen rates sort of peak, and Morgan Stanley's interest rate team, our view is that the second half of next year we might actually see some rate cuts.
No, I'll take it. Long out on the yield curve. Why is the front end an opportunity but long end is not?
Well, because the expectation would be that we're in a slowing economy with slow growth, and that, especially, I think, even given some of the geopolitics, that we could see in the second half of the year rate cuts, and that could disproportionately impact the front of the curve. And right now, that's where the cash flow is.
We've heard from a few Fed members, of course, Lael Brainard yesterday, and I think it was Harker a little bit earlier today, who seem to be making a case publicly that the Fed should maybe cool its heels a little bit, not necessarily pivot, but certainly not continue on this 75 basis point trajectory that we've been on here. And when you look at the data as we know it to be, and you look at some of the commentary, do you think there's a rational case to be made for doing that?
Yeah, absolutely. And I think the other thing that's interesting is that the Fed started this rate hike cycle talking a lot about it, but not doing much about it, and letting the market sort of catch up to that. And it's interesting that we're starting to see this now on the tail end as well. That would be something I would pay attention to. But again, waiting for that to happen is a past tense activity, and investing is about forward opportunity, and investors should be stepping into obviously crushed areas of the market that are presenting great value and great income opportunity, not waiting for that.
We've talked to you in the past a lot about consumer sentiment and technicals and how much that can also drive fundamentals of the market. You look at an S&P that's trying to hold on to 4,000, 3983. We've talked a lot about round numbers and the technicals that 4,000 represents. How much of that is also a factor when you're thinking about the investment opportunity?
It's a factor, but I think right now it's about repositioning within the S&P. So you want to be moving from market weight to equal weight type investing.
Don't tell that to Romaine.
I just did.
You heard me. Weight S&P.
Well, it's a much more tricky way to be investing, but the reality and the truth of it is that this is a market that the S&P is very heavily weighted, continues to be concentrated in these top 10, positions. And so unpacking that, I think, presents a greater opportunity than necessarily trying to time in and out of the market due to technical tops or bottoms.
But do you think this will sort of be a broad market trajectory, if you will, that basically everyone is going to basically participate in this more or less? Or is this going to be a little bit more, I guess, disjointed, where you're going to have certain sectors, like we saw earlier this year, where energy just sort of outperformed everything?
Yeah.
Is that going to be what we should prepare for?
It's such a good question. It's a classic kind of winners become losers, losers become winners, and yet the entire data set of the market has a mean average return of 8 to 10%. And so clearly placing money within the market from that perspective, I think is going to be it's really important. This is a very subtle and nuanced market.
I don't have to be in the market to get. I could get 4% in the Treasury market. I get 6 or 7 in credit and corporate bond. I can get a CD right now for like 3.5%.
You can make your fortunes in crypto too. I don't know. That's what somebody told me.
Well, I can lose my fortune in
I
crypto.
have to tell you, I think that it's so interesting, all of these things that are happening, because we just go back to how incredibly powerful for investors transparent, liquid, dynamic, and supervised markets are for creating wealth.
Yeah.
FOMO is hard, though, and I hear when interest rates are zero, we've had these conversations, FOMO is hard. It's hard to not be in these speculative assets. Now that yields are rising, it's easy, hindsight's 2020, to realize that we're all trying to figure out the value of something when rates aren't zero. What are the conversations that you're having around crypto right now?
Well, I think it's pretty clear, and I've been talking about this over the past year, that this is an unfolding technology and an asset class yet to be proven or defined. And so my advice to clients has been to take advantage of that consumer discretionary sector that's down 40%. Some of these companies are off, 2/3 that are fantastic businesses that you can step into to get those double-digit returns. And I think that is an antidote to FOMO. There's something much bigger going on, though, globally around this issue of how we transact, communicate, and define the validity of financial markets. And I just want to say how nice it is that these markets have been separated and not integrated, because the last thing that we need right now is a nationalized bailout of crypto.
Oh, gosh.
Well said.
From your lips to God's ears.
Okay.